Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast, Passive Investing Edition. My name is Randy Smith, and I am your host, and I'm the founder of Impact Equity. And our goal here is to help educate and inspire the passive investor as they begin or continue their journey shifting from traditional investments over to investing passively in real estate. We have an awesome educational show here today with our guest, markgross. Mark, welcome to the show.
Thank you very much, Randy. I really appreciate the opportunity.
Outstanding. Well, very good. We have for our audience tonight a really great show on cost segregation, which is one of the many benefits that real estate, as well as probably other asset classes, will benefit from a cost segregation study. And Mark is an expert in that field. So, Mark, I'm going to just hand it right back to you to hear kind of a high-level overview of what it is and how it helps and what we can do to benefit from this type of strategy.
Sure thing, Randy. Well, basically, when in the IRS tax rules, there's straight line depreciation, and then there's cost segregation. Now, what a CPA may do is a straight line depreciation of 39 years, so that you take a look at the purchase price, subtract the land, because you can't depreciate the land, and the balance you would depreciate over 39 years. Now, with multifamily residential properties, that straight line is 27 and a half years. So the same would apply as far as looking at the acquisition cost minus the land and doing the straight line depreciation. Well, think about it this way, and especially in today's inflationary times, is a dollar today worth more than what's going to be in the future? And when do you want to wait that long in order to get your depreciation? What we do with cost segregation is an alternative method, which front-end loads a lot of those depreciation costs into the first year with bonus depreciation and with our studies. So rather than wait for that long period of time to do the depreciation, with bonus depreciation, you can take a look at any component within the structure which has a less than 20-year life and depreciate that 100% the first year of ownership.
Okay. So let's say, sort of to back up just a little bit here. So as a real estate owner and specifically as an LP investor in syndications, you own the asset or you are part owner of the asset. And one of the expenses associated with owning real estate is depreciation. And that expense is because normal wear and tear kind of decreases the value of that asset over time, is what you're saying.
Yeah, and it's a non-cash expense. I mean, you're not but still, it's treated the same way when you look at your P&L statement when you have a deduction. So let's say, for instance, you were to have $100,000 in income, but you were to have additional depreciation of $100,000 that would net against your income. Therefore, you pay zero.
Okay, so let me just restate that real quick. So if your apartment complex made $100,000 in income, this $100,000 in expenses due to depreciation means in the eyes of the IRS, you've earned no taxable income.
That's correct.
Okay, so that can have a pretty big implication on your pocketbook come tax time, I'm guessing.
It's huge. But one thing that really needs to be taken into consideration is that it's not quite as simplistic as that, because there are different variables in regards to what limitations a limited partner might have versus a general partner versus a real estate professional. Because if you meet the qualification of a real estate professional, which is kind of like the gold standard of using depreciation, you can use it against losses against other properties, against your spouse's income. I mean, there's a whole lot you can do with that. However, you really need to meet the IRS guidelines of what is a real estate professional. Do you work at least 750 hours a year doing that? And there's a whole lot of other criteria. So it's hard for me to say, this is exactly what your tax benefit is going to be without knowing what your specific circumstances are.
Awesome. Okay. And that's a really good point. So let's do I am not a CPA and can't give tax advice. Don't take your tax advice from a podcast. But I think that piece that you mentioned is it's that unicorn that every real estate investor is searching for, where maybe one of the two spouses is a high income W-2 earner, and then the other spouse is a real estate professional in the eyes of the IRS, which allows these passive losses then to count against your active income. I think that's kind of the golden egg, right? Okay, so that can actually be extremely beneficial to not only just the high income W-2 guy, but really anybody who has any type of tax obligation at all. So that's your specialty, it sounds like, with these cost segregations. So let's dig in. I know there's this other thing which is called 100% accelerated depreciation, and I've heard that's phasing out, or there's some changes coming to that potentially in the future. Can you walk us through what's going on there?
Yes, absolutely. It's called bonus depreciation, and it came about at the end of 2017 as part of the Tax Cuts and Jobs Act. And prior to that time, bonus depreciation was applicable for new construction. However, with the Tax Cuts and Jobs Act, it became available for new acquisitions as well. So that's when it started. There have been some previous iterations of it in previous years, but we'll just kind of focus on the most recent years. Now that is scheduled to start phasing out. 2022 is the last year for 100% bonus depreciation. In 2023, it goes to 80%, and it has subsequent reductions of 20% per year until it goes away.
Okay.
However, we all know that this is based on whatever the legislation is in Washington, D.C. And everything there is subject to change. And we don't have a crystal ball here to know exactly what the future is going to hold. We speculate that in some form it will probably come back, but all we do is focus on what are the current tax rules and regulations, and how can we apply that for our clients.
Yeah, and thank you for saying that. We never know what's going to happen with the tax environment and what that's going to look. And the current administration generally has a big impact on what's going on there. But some of the guidance that we hear is let's not make decisions based on what the tax guy is telling us. Don't let the tail wag the dog, essentially. But the tax code is actually drafted and created and built to really incentivize certain behaviors. So when this new tax act that was rolled out, one might read that to believe that the government and the tax code is actually encouraging folks to really come in and invest in these areas, because where tax advantages occur, that's where the dollars are going to flow. And by indirectly or maybe directly putting codes in place that encourage our dollars to go there, then that really spurs economic growth. So
that's why they did roll out the opportunity zones, which helps with capital gains. And that's why there's also there was some hubbub about the 1031 exchange about that going away, but that didn't happen because of political pressure. So So you're right, that is the incentive, because they realize that real estate investors are investing in property, investing in people and growth and things of that nature. So even though there's a tax advantage for them personally, there's a lot of advantages for the economy.
Okay. Well, let's talk if we can. I know the bonus depreciation where you get 100% year one is just fantastic. And everybody's super excited about it and taking advantage. I think we're going to see a lot of deals over the next 90 days that come out for Q4 that are claiming things like, act now to take advantage of, the last 100% bonus depreciation. But next year, when we are into an 80% depreciation, that's still a pretty advantaged opportunity for us to still invest in this space because of that benefit. Would you agree?
Yes, absolutely. In fact, we've been doing cost segregation studies for 20 years. And that was way prior to when this most recent bonus depreciation came about. So even if bonus depreciation were to be zero, there's still a lot of advantages to cost segregation and what we can do with accelerated depreciation. And some people have the misconception that because bonus depreciation is being phased out, that cost segregation is. And that's not the fact. It's just one portion of it.
Okay. I can imagine in your office when this new this new thing was rolled out, you guys were probably all high-fiving in the office and very excited about what this meant for the cost segregation business, I suspect, right?
Yes, absolutely. We've had incredible growth over the past years, actually over the last 20 years, but especially recently. Yes.
I bet. So let's do this. Now, I generally talk in terms of multifamily because my company, we partner with operators and we help to raise capital and help investors generally in the multifamily space. But my understanding is cost segregation can really be used in almost any of these asset classes. Can you talk to how wide of reaching this strategy goes into other asset classes or categories?
Absolutely. It really works with every property type. I've done a number of retail, like triple net lease properties, like a Dollar General store or Walgreens or CVS, something like that. It works quite well with industrial properties. However, not from a percentage standpoint, not as much for those type of properties, because think about it this way. Your typical manufacturing and distribution industrial property might have 80% of it in their industrial space and maybe 20% in office. You're going to have a lot more of componentry within that office portion that you can depreciate quicker than you will in the other structure. Now, that doesn't mean you can't benefit from it, but from a dollar perspective or square foot perspective, it's going to be less, but still beneficial. Another thing, too, is when you think about the fact that you can't depreciate land, you know what's a good option for cost segregation is a golf course. Now you think, how can you use that for a golf course? Well, think about this. Your typical golf course is going to have a clubhouse. It's going to have parking lot. Parking lot's a 15-year property. You have a lot of other infrastructure within that can be accelerated, depreciated. So really, it virtually works for any property type: short-term rentals, residential rentals, things of that nature. So it works well.
So that, and I think that brings up a really good point. There's probably some type of threshold, and maybe I'm wrong here, but is it, if you have a house which is worth $400,000, that may or may not make sense versus a $50 million apartment, which certainly makes sense. Are there thresholds that you like to use or kind of certain points where it makes sense to get somebody like you involved?
Yes, absolutely. In fact, what we have is a questionnaire for our preliminary analysis, and we do a free preliminary analysis for our clients. And one of the questions we ask is, how much did you pay for the property, and what is the land value of it? And the threshold for that, typically I use is about $500,000 or greater. However, we can do that for smaller properties. I'm working on some right now, which are like a short-term rental and other residential rentals, where we can probably go down to around $250,000. But in a lot of areas like Southern California, Manhattan, New York, I mean, that's really not going to be an issue. But you get some tertiary markets in the country, that may not work. So that's one of the areas where it may not be beneficial. There's another one where not everybody's cognizant of, and that is if you're planning on doing a quick flip on a property. Let's say you buy it and you're planning on selling it in the next year or two. Well, there's something called a recapture tax. And that's another question that we have in our questionnaire is how long are you planning on holding this property? Because if you're planning on holding it for 3 to 5 years, whatever the benefit of having that additional cash up front versus the recapture tax is beneficial. But if you're planning on doing a quick flip, it probably isn't.
Okay. So something less than a year definitely doesn't make sense. Once you're in that 2-year plus range, it can start to make more sense.
Probably three to 5.
Okay. Okay. And I know you're not a CPA, so you can't talk necessarily about tax rates, but my understanding is the recapture is generally at a lower amount than what the benefit is that you get on the front side. Is that
correct?
Been your experience? Okay. Okay. So one of the questions that I get, and I personally have, is there's this idea when you're investing in the multifamily space that year one, a certain percentage of your investment is possible to come back as a passive loss. And I hear, and I've actually personally seen everything from like 55% of that initial investment up to almost 80% on one of my investments. Is there a good rule of thumb or something that you think is a comfortable number to share or expect if you're trying to plan for the year?
I think the answer is it depends.
Okay. I love that answer. Yeah.
I don't like to shoot from the hip on this because there's so many different variables. Like
Okay.
we discussed before, you the situation of a real estate professional, the situation of a passive investor. If you're looking at it from a tax year and you're looking a passive investor can take the losses against their passive gains. Well, let's say the property is acquired at the end of the year, and from a revenue standpoint, they really don't have much in gains. It may not be very beneficial for them, and I feel that sometimes may not be intentional, but sometimes I think syndicators and others maybe overemphasize what the tax benefits are, and we don't like that.
Okay. No, that's great. And thank you. I appreciate that as well. Because yes, people will do different things with different motivation and incentives for themselves. So very good. So let's see here. I'm wondering, we talked about asset classes. We talked about the phase out process and possible cost. Actually, we didn't talk about cost. What do these things cost? Are we talking tens or hundreds of thousands of dollars or hundreds of dollars for these cost segregations?
Well, again, it depends, and it's not a percentage base. In fact, I just had this question this morning when I was at a business meeting. Think about it when you have a property tax appeal. You have an attorney which will say, I will reduce your property, get your property taxes reduced, but I'm going to take a percentage of the savings.
Yeah.
We don't work that way at all. What we work on is a flat fee. Now, obviously, like you mentioned, that's going to vary depending on the property. Let's say you have a fourplex, or you have like you mentioned, a 20-story office, or multifamily or building like that. Obviously, the cost of the study is going to be significantly more for the larger property. But what we do is we provide a free preliminary analysis based on information on the property, which will say, this is a very conservative estimate of what we anticipate your tax savings to be. And this is what the cost of the study is going to be.
Got it.
Over 90% of the time, when people follow through with the study, their savings are greater than what our estimate is, because we'd rather, under promise and overperform on that rather than, give them the bad news. You know what? We didn't hit your numbers.
Sure.
And usually when we don't hit the numbers is because maybe the information we were given up front isn't accurate. But that's how that works.
Okay. Well, that makes total sense. And it sounds, I love anybody that says under promise and over deliver. That's just a catchphrase I love. What I love even more is when I see people actually practicing it in applications. So that's great. Thank you. And I guess maybe one final question before I ask some details about your business. I'd love to hear, like, what does the process look like? Are guys in suits coming out, or in engineering gear and tools and all kinds of things? Or is this something that is going to interfere with the day-to-day activities of what's going on in the specific unit or house or office complex or apartments? Like, what does that look like?
Sure, that's a great question. First of all, we've completed studies in all 50 states, all property types. We have boots on the ground throughout the country, so that every one of our studies requires a site visit. I know there's some other providers that don't do that, but one of the things that we offer is that we will defend the study at no cost in case the client ever gets audited. And in order to do that, we need to have boots on the ground. We need to take hundreds of photographs of every property and have all that information so that we can, provide that. The way our process works is that when we provide the preliminary analysis and they move forward, we have the site visit, and then we look at the appraisal. We'll look at the closing documents, so the offering memorandum, any other documents that are available, and it's typically a 4 to 6 week process for the engineers to go through and analyze all the data, and zoom in on all the pictures. What's this model, this security camera? I mean, it's incredibly intense, because our objective is to be able to provide the maximum depreciation available for the client.
Okay. Yeah, so it sounds a little more intensive. I was picturing a guy with a clipboard walking from unit to unit, spending maybe a minute in each room, but it sounds like it's much more detailed than that.
Well, it's taking the pictures, because then what happens is that information then goes back to the engineers with a lot of that other information that I previously indicated to be able to complete the study. So it's a very drawn out process.
Okay. Well, yeah, very good. Thank you for that detail. And so I think with that, just like anything, there's probably good cost segregation companies and there's less good ones, I suspect. And when like I mentioned, I've seen variations between like low 50% and upwards of high 70% in that number. So what differentiates you and your business from some of the other players out there to maybe not get the highest number but to get the most accurate number?
Well, that's our objective. We're not trying to meet a specific number.
Yeah. We're
trying to provide what is the accurate amount. Like I indicated, we will defend the study at no cost if there's an IRS audit.
Mm-hmm.
If there's bad information, then that's not good for us. It's not good for the client.
Yep.
And we want our client to be able to sleep at night knowing that the information that we provide is defendable.
Okay, very good. Well, yeah, no, I appreciate you walking through. I've learned a ton in this conversation. I thought it was much simpler than it is, which of course seems to always be the case when you dig in. But no, I appreciate you walking through all of those details. So if you could, if one of our listeners wanted to reach out to you, what would be the best way for our listeners to find you?
Well, I'm available on LinkedIn. I've got, I think it's over 8,000 or 9,000 contacts there.
Oh, goodness.
And my information is markgross at costsegregationservices.com. And my phone number is 630-329-9801. Even though I'm Chicago based, I'm working on projects now from Hawaii to California to Florida, the East Coast, all over.
Fantastic. Well, thank you so much. I really appreciate you coming on the show. I think this was super insightful and brought a ton of value to the audience. I would encourage you, whether it's Barks Group or another group, definitely look at this cost segregation space. It can provide amazing value to your investors or to you as an investor. But certainly connect with Mark or connect with me to discuss it further. And Mark, thank you again for being on the podcast. And I'll look forward to seeing you in our meetups here, I'm sure, in the next week or so.
Thank you, Randy. I appreciate the opportunity. Thank you very much.
All right. Thank you, everybody. Until next time. Thank you.
Well, there you have it, ladies and gentlemen, another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.